I'm going to run through a fairly long presentation to introduce the subject. And basically, as you know, this is basically a discussion on the ongoing crisis and looking at perspectives both from the North and the South. If I may, I think it's useful for us to remember that that the crisis is not something which completely came out of nowhere. Many people had warned that crisis was building up. There was a great deal of concern about the clearly unsustainable global imbalances which preceded the crisis, not unlike the global imbalances which preceded the end of Bretton Woods system in 1971 and the Plaza arrangement of 1985. Also, there has been, as you all know, a very serious problem in the absence of any real international financial system to speak of. After 1971, my old professor Robert Triffin suggested that we are living with a non-system. And I think despite Bill Clinton's promise in 1998 to have a new international financial architecture, there really was no system to succeed that. But also very importantly, I think we all know that the last 2.5 or 3 decades was dominated by an ideology of deregulation, of self-regulation and liberalization, including capital account liberalization. And there were very important cheerleaders of processes of what might be termed financial globalization, although there was evidence from the outset that financial globalization neither contributed to growth and in fact exacerbated instability. And another important point which I think needs to be made, and why this discussion has chosen to focus on perspectives from the South, is that by and large developing countries, whether emerging markets or non-emerging markets, have been rather innocent victims in this crisis. And they have suffered doubly because not only have they been innocent victims, they have also been constrained from acting in a more bold way in response to the crisis, both by the ideology as well as the policies which have been pursued by certain powerful institutions. Finally, I think there has been, as you all know, a very important shift away from the old G7 arrangements in favor of a G20 type arrangements, which at the face of it seems much more inclusive, but one should emphasize that it really keeps out 171 other countries which are part of the international community and for which the G20 certainly feels no real serious accountability. The attempts by the United Nations to try to influence the course of events, largely under the initiative of the 63rd President of the General Assembly, Father Miguel Descoto, in appointing Professor Stiglitz as chair of a commission to look at the problems which have given rise to the crisis and its impact, basically have been rather modest. The impact of the commission's report has been rather modest. We have seen very little serious consideration among the powers that be of the major suggestions for reform. But perhaps it's a question of timing. Until fairly recently, for example, there was very little effort to try to transform financial regulation in the centers of finance, London and in this country. But things seem to be changing. Team B, at least in the form of Paul Volcker, is now more prominent. But it remains to be seen whether Team C will actually make an appearance at all. But that, I think, may be wishful thinking. But let me quickly run through a number of slides to give you a sense of the global imbalances. As you can see from this, the global imbalances really grow pretty much from the middle of the past decade. And although the United States runs a huge deficit, the main surpluses are actually run by the oil exporters, contrary to the impression Paul Krugman might give you, that it is basically China which is the root of all evil. And it's important also to recognize that the imbalances have come down with the slowing down of the economy for rather obvious reasons. But here again, you get a sense of the size of the US deficit and the relative size of the surpluses run by different countries. And what is very apparent here is that China begins to run a surplus with the rest of the world fairly recently, from the middle of the decade. and not really before that. Because although it's running a huge surplus with the US, it's actually running a significant deficit with many developing countries. Now, the promise of financial globalization was that capital would flow from the capital rich to the capital poor. Instead, as you can see from this, half the capital flows actually to the United States, and developing countries account for less than a fifth of the capital inflows. Now, US macro-financial policies, particularly of the last decade, but arguably even before that, as suggested by Joe Stiglitz's book on the Roaring 90s, actually is really part of the problem. And I've already mentioned the problems of the non-system, the kind of macroeconomic policies which are pursued, particularly during the Bush period. And then you have the problems of increasingly lax financial regulation. And it's important to recognize that much of the deregulation of finance, the end of Glass-Steagall, for example, actually did take place under democratic administrations as well. Now, the low savings rate is something which everybody knows about, and then you have the problem of US consumption and the kind of hubris accompanying the growth of the financial sector in both the US and the UK. To give you a sense of the fragility of the system, I think this inverted pyramid gives you a sense of the kind of fragility of the system, which was facilitated by this phenomenon which is often referred to as financial deepening. As Paul Volcker has suggested more recently, probably the only significant useful financial innovation is probably the introduction of the ATM, and even that has not actually added any value per se. And he, among others, have pointed out that financial deepening really did not add any real value to. Now, these bar charts basically give you a sense that although we often think of globalization as involving trade integration, in fact, the growth of financial integration, as represented by the upper blue line, has been far greater than the growth of trade integration, as represented by the lower red line. And despite greater cross-border flows of finance, especially since the 1990s, we find that real investments, or what economists call gross fixed capital formation, has hardly increased. In fact, it's actually trended slightly downwards. Now, financial globalization has resulted, as I pointed out, suggested earlier, in a net flow of funds from the south to the north, what Lucas referred to as capital flowing uphill. This only becomes a problem because of the predictions of neoclassical economics in expecting capital to flow from the rich to the poor, and the contrary is actually taken place. The cost of funds has not actually declined because of greater intermediation and the concentration of oligopolistic power, which has enabled OECD financial rents to significantly increase, particularly in the OECD economies since the 1970s. There has also been greater volatility as well as lower growth and higher instability. This gives you a sense of the flow of funds from the south to the north. The blue line sort of sums it up for the developing countries, the dark blue line. Now, the short-term flows have been especially problematic. They do not contribute either to investment or to real growth. They often contribute to asset price bubbles and consumption binges, and as Justin Lin has pointed out, sometimes they contribute to overinvestment, which poses a serious problem for us today as we try to get out of this crisis. The fact that there is a considerable overcapacity becomes an impediment to encouraging new investments in this situation. And this is a subject which I suspect will preoccupy us in this discussion. Now, moving quickly, I think if I may sum up the argument made so far, we have a non-system, we have double standards in the international economic governance, we have a problem of inadequate and inappropriate regulation, and we have a failure of international cooperation. Now, the financial impacts on developing countries of this crisis have been varied. We know that stock markets in emerging markets have collapsed much more. We also know that reversal of capital flows, FDI has also been adversely affected, and we know that borrowing costs have gone up, especially in so-called emerging markets. And financial positions going into the crisis, particularly in East Asia and Latin America, was stronger because of the build-up of foreign reserves, which is also, of course, as you all know, part of the problem. Now, reserves have rapidly evaporated with the collapse of exports, particularly in 2008 and 2009, and fiscal space has also been very limited and constrained. This basically gives you a sense that although borrowing costs have come down slightly, they have significantly higher than they used to be. We do know about the spread of contagion. I won't dwell on this. There are many vectors to consider, and we also know how all this has contributed to what is essentially a deflationary spiral. And again, I won't elaborate on this. One important difference between the current situation and the situation in the late 1970s is the fact that although there was stagflation in the West, in the industrial West, in Latin America and in East Asia, there was actually very rapid growth during the late 1970s, thanks to the availability of cheap petrodollars, available at low interest, and so on and so forth. What we have this time round, however, is a situation that, thanks to globalization, a much more integrated international economy, and the fates of economies much more closely tied up than before. Now, prospects for this year are uncertain, but I think optimistic scenario would suggest growth of slightly over 2% at the world level. Now, most developed economies seem to be coming out of the recession since the second half of last year. And we also see some hopes of some kind of a recovery in the so-called transition economies. And in developing countries as well, you see some slight improvement expected during 2010. Now, at least 60 developing countries were adversely affected last year, experiencing contractions. And in total, including developed countries and transition economies, over 100 economies experienced contractions last year. Now, the economies in transition were initially expected to do much worse than the developed economies, but as it turns out, developed economies generally did much worse. Now, in developing economies and in the least developed countries, although they didn't move into negative territory, the fact that you have higher population growth, generally speaking, in those economies basically means that on a per capita basis, they could be much worse off. Now, we also know that oil prices have come down, that food prices have come down as well since their peak in early 2008, but they remain higher than they were in the preceding period. World trade did collapse significantly by over 10% in 2009, and there is a general consensus on the estimates of the trade collapse. Now, as you can see, the exports from developing countries fell much more than exports from the OECD economies. And the prices of minerals, oil as well as metals, have declined, although they have begun to pick up a little bit. Now, to summarize the trade impacts, basically we see that exports have declined, terms of trade have moved against primary exporters particularly, and that trade surpluses and reserves have run down pretty quickly. The only silver lining is lower energy as well as food prices. Now, for the least developed countries, the whole question of aid flows has been notoriously unreliable, and just to give you a sense of the international commitment to addressing Africa, you can barely see the sliver of ODA to Africa on the right-hand side of about 26 billion, and just contrast that with the almost 20 trillion which has gone into fiscal stimulus as well as other recovery efforts. Now, my only point really is that the ODA figures are often quite misleading, because of the high interest payments which many developing countries have to make on ostensibly discounted loans. So that although the Democratic Republic of Congo is supposed to have received almost $5.5 billion in ODA in 2003, they actually only received about 400 million in net in actual transfers. Another significant difference between this crisis and the earlier regional crisis in Asia, for example, is that remittances have been also very adversely affected. And part of the reason, of course, is that in the migrant workers in host countries have experienced significant drops. Now, the social impacts are still very difficult to measure. There are all kinds of figures which have been touted. And perhaps, given that the depth of the collapse last year was not as deep as initially feared, perhaps the figures are not as dire as originally forecast by the ILO, for instance. Now, the point I want to make with this bar charts is that it's extremely important that countries be able to respond to downturns in a timely way. And the fact that you have a delay, for example, of 3 months can often lead to a delay in terms of the impact of the stimulus measures, which might take well over a year and a half, according to the ILO's estimates. Now, this, I think, is significant because developing countries were basically deterred by the IMF from undertaking more robust recovery efforts earlier. Now, the failure of international cooperation is another major problem, and as we have done our own modeling exercise here, and we argue that if we had a much more coordinated effort in response to the crisis, we would have a stronger and a more robust recovery, which would actually everybody would actually benefit from that, developed countries as well as developing countries, as well as transition economies. Now, a major consideration going into this crisis, and obviously recognized by many governments now, is that while output recovery can often take less than a year, in the 1991 downturn as well as the 2001 downturn, the output recovery took basically about 3 quarters. But the job market recovery or employment recovery took 2.5 years in the case of the 91 downturn, and took almost 4 years in the case of the 2001 downturn. So it remains to be seen how long job recovery is going to take this particular downturn. And this, of course, is a matter of grave concern, especially for those who are adversely affected. Now, the international responses have not been as robust as I would have liked. And although the shift of leadership from the G7 to the G20 may have had some positive effects, it remains to be seen. The failure to act on some of the more of the stronger recommendations for response is a matter of some concern and disappointment. The last bullet point here basically underscores that the June 2009 effort at the United Nations basically did not have really much of an impact, largely due to the indifference of the major economies and the leadership of the major economies in the world. Now, I want to contrast this with what happened in 1944. In 1944, the Bretton Woods moment is very significant in my view because it represents a recognition by Roosevelt of the need to move away from the League of Nations type of framework, and he, as you know, convened what was called the United Nations Conference on Monetary and Financial Affairs, although the United Nations had not come into existence and did not come into existence until a year later. And it was very much a US initiative at that time, whereas Churchill took the view that there was no need to have any kind of multilateral meeting. It was enough for the US and the UK to come to some kind of understanding as to the shape of international monetary and financial affairs. And as you also know, at Bretton Woods, it was envisaged that you would have basically 3 prongs of a post-war international economic governance involving the Fund, the World Bank, and very importantly, an international trade organization, which unfortunately the US Congress vetoed. And so the promise of the Havana Charter of 1948 was not really met. Now, Bretton Woods was not just about monetary and financial stability. It was also about creating the conditions for growth as well as employment creation, and very importantly, of course, post-war reconstruction as well as post-colonial development. In contrast, if you look at the G20 meetings, Washington, London, as well as Pittsburgh, they pale in comparison with what was achieved in Bretton Woods. And I think it is important to recognize that the Stiglitz Commission did make a number of recommendations which would go some way to meeting the promise of Bretton Woods, if the promise of Bretton Woods was to be realized in the current period. Now, just let me conclude by suggesting that while I suggest a rather pessimistic scenario, I think it's very important to recognize that it's not all over yet. And given the turn of events in this country in recent months, and given the continued persistence of the crisis, and given the possibility of a double dip scenario, it is quite possible that things may change. The strength of the recovery in the larger developing countries, China, Brazil, India, and so on, may also mean a shift in the balance of affairs, which may well have fairly significant consequences on a range of fronts. So without any further ado, let me now invite our three other panelists to come up, and invite Justin Lin to the podium to address us. Justin Lin is the chief, please, Joe, Prabhat. Justin Lin is the chief economist at the World Bank, and he didn't directly succeed Joe Stiglitz, but Joe Stiglitz occupied the position in the second half of the 1990s. So Justin, without any further ado, can I invite you to come and address us? Thank you.
Well, thank you very much. Jomo just gave a very comprehensive overview about the causes of this global crisis, the current situation, and so on. And so my talk will focus on 3 points. The first one, I share with you that the recovery is quite fragile. And the second one, I'd like to argue that we need to continue some kind of government stimulus, but the conventional Keynesian type of stimulus will not work. We need to look beyond the conventional wisdom of Keynesian stimulus. And the third one, we need to have global coordination and cooperation. And if we can have this kind of global coordination and cooperation, we may turn the crisis into an opportunity for more sustainable and inclusive globalization. Regarding the fragility of this recovery, we know recovery was mainly driven by two forces. One was fiscal stimulus adopted by the major country so far. And the second one was because of the restocking of inventory. And by that, according to our forecast, last year, the global GDP contracted 2.2%, and this year is likely to grow 2.7%. And the trade last year contracted 14.4%, and this year is likely to grow 4.3%. However, the main challenges in the coming months and years is something Jomo just mentioned, excess capacity in the real sectors. And according to the data, in spite of this recovery due to the restocking of inventory and the fiscal stimulus, in high-income countries especially, in January this year, its capacity utilization rate was still about 14.5%, lower than the level achieved in 2008. the situation in developing country was much better. And for some countries like China, its capacity utilization rate or its labor industrial production was already exceeding the level in 2008. And we know that with large underutilization of capacity, the real sectors will have some kind of downward pressure. Because with large underutilization of capacity, certainly the unemployment will be maintained in a high level. And under that kind of situation, certainly it hurts consumer confidence. And also with large excess capacities, it will be very hard for the private sectors to find good investment opportunities. And that means even the interest rate is driven down to almost zero. But private investment, business confidence will still be very low. And under that kind of situation, we are going to see a very, very low recovery. And it will also put a pressure on the financial sectors. Well, last year, there were 140 banks in the US, collapsed. And according to a recent FDIC report, about 702 banks in the US are in the watching list, are in some kind of dangerous position. So because of the restocking of inventory, those kind of force, will come to an end or already came to an end. And the fiscal stimulus is likely to lose some kind of steam. So with these kind of scenarios, I think a double dip is a real possibility. A double dip is a real possibility. And under this kind of situation, how can the government cope with that? First, I'd like to say monetary policy may not work. Because if you use the monetary policy, the best you can do is to drive the interest rate down to zero, and now it's the case. But if you don't have good investment opportunity, people will not respond. If you do not have good job security, people will not increase their consumption also. And it also is going to hurt the developing country, because low interest rate most likely is going to encourage carry trade, short-term capital outflow to the emerging markets, and put a pressure on their exchange rate, as well as the bubbles in the equity market or real estate market. And so a better way might be continue to use the fiscal stimulus, increase the government spending. But to continue government stimulus, there are two issues that in people's mind. The first one is a sharp increase in the public debts. And according to some studies show, among the high-income countries of G20, by the time of 2014, their public debt is going to reach about 120% of their GDP. And the people, are doubtful about the sustainability of this high public debt. And the other concern is the so-called Ricardian equivalence. The government can use debt financing to increase its spending. But people may anticipate in the future they need to pay back their debt. And under that concern, they will increase their saving. And as a result, the net increase in the demand will be quite small. And so that won't be able to absorb the large excess capacity situation. Certainly, it's a theoretical possibility. And we do find some empirical evidence to support that. For example, in the 1990s, Japan encountered similar situation as we encounter now. And starting from 1991 to 2002, Japanese government was very aggressive in use fiscal stimulus. And its debt increased from 60% of GDP in 1991 to 140% of GDP in 2002. And during those period, as you know, it was a lost decade to Japan. And the main reason was because at that time, the Japanese government used a lot of fiscal stimulus, but people increased saving. However, I like to say, the reason that high debt level is a concern, as well as the reason why Ricardian equivalence is a possibility, it's because of the investment did not increase the productivity of the economy. And without increase in the productivity of the economy, certainly the people will feel that they need to pay back the debt in the futures and start to saving. And the evidence is that, a friend of mine in Japan in the 1990s told me that he stayed in Japan for 4 years, and the road in front of his apartment was dig out, paved, dig out, and then paved 6 times in 4 years. And that was a conventional Keynesian type of fiscal stimulus. Certainly it was not effective. It could not increase the productivities, and so the debt accumulated, and the GDP remained very sluggish. But we do also find some other way to make this kind of fiscal stimulus much more effective. For example, in the East Asian financial crisis, China also encountered a similar situation, and there was a deflation, there was a huge underutilization of capacity. And starting from 1998 to 2002, Chinese government also used fiscal stimulus to boost the demand. But most of those fiscal stimulus was used to make investment in infrastructure, which was the bottleneck of China's growth. And to give one example was the highway system. In 1997, the highway system in China was 4,700 kilometers. And starting from 1998 to 2002, those 5 years, the highway system increased 5 times in China, from 4,700 kilometers to 25,100 kilometers. And those kind of investment, certainly in the short run, create a job. But more importantly, in the long run, it boosts the growth potential. From 1979 to 2002, the average annual growth rate of Chinese economy was 9.6% per year. And at that time, most people argued it was impossible for China to maintain those kind of 9% and plus growth rate anymore. It's already 23 years. And Japan, Korea, and so on, in their best year, only maintain those kind of growth rate for 20 years. But after 2003 to 2008, those 6 years, the average annual growth rate in China did not decline. Not only so, it increased to 10.8%. It was a 1.2 percentage increase in the growth rate. And the possibility was because of the growth bottleneck has been released by the investment during this fiscal stimulus periods. And also as a result, the government debt as a percentage of GDP before the East Asian financial crisis was about 20% of GDP, and it increased up to about 33% of GDP in 2002. And after that, because of economic growth rate increased, so the debt ratio also dropped down to now about 20%. And this is one example. And in fact, we can also find another example. Korea this time also encountered similar crisis. And Korea also was quite aggressive in using its fiscal stimulus. It used about 2% of its GDP. And 80% of those GDP was used in the green economy. As a result, in the past 2 years, Korea created about 200,000 jobs. And Korea's GDP growth rate this year is likely to be about 4.4%, among the highest in the OECD country. And again, because those kind of green investment released Koreans' bottleneck for growth, improve its energy efficiency and so on. So from this kind of experiences, we find we need to continue the government support in order to prevent the vicious cycle of downward pressure. But we need to make this kind of investment in areas which enhance productivity. That's my second message. And for the global economy, for the high-income country, well, if they want to continue the stimulus, certainly the green economy is an area that they can consider. However, for the high-income country, only green stimulus may not be large enough to help the country in high-income group to get out of this crisis. And so we need to have a global cooperation in the developing country to participate in this kind of global effort. For the developing country, they have a lot of bottleneck for growth, both in the energy efficiency, environmental issue, and more importantly, in their infrastructure, their bottleneck of growth. And for the developing countries like China, India, those emerging markets, certainly they will have enough resources, both their foreign reserve or fiscal space, to engage in fiscal stimulus. But for many other developing countries, especially long-term countries, they are constrained by their fiscal space and also their access to foreign reserve. They will not be able to participate. So under this kind of situation, high-income countries, they have hard currency. They could use debt financing, but they don't have good opportunity for investment. Developing countries, they have good opportunity for investment which can enhance the productivity. Those kind of projects can self-liquidate, can make enough return to repay those kind of investment in the future. But they are constrained by the foreign reserve. So under this kind of situation, I think we can have a global solution. Find a way to channel some fund from the high-income country or reserve-rich country to make investment in the developing country. It will be a win-win situation. However, this kind of possibility need to overcome two issues. The first one is a coordination issue, because if only one high-income country or one reserve-rich country, do this kind of cross-border stimulus, we know the huge leakage effect. So the individual country will not have the incentive to do that, and then other people will free ride. To overcome the free riding problem, we need to have a global coordination. And the second one is that even we have this fund, we also need to have good mechanism for implementation. And I hope the G20 can play this function for coordination. Come up with this concept, discuss this proposal, and make it this as an agenda in the G20s for the coordination. And secondly, for the implementation, luckily, we have the Bretton Woods system now, the World Bank, the Regional World Bank. They are mandated to carry out those kind of projects. And that's one of the main purpose of, to have those kind of institutions. So if we can work through this kind of institution, then maybe with the fund and with good investment, we can get out of this global crisis in a sustainable way. At the same time, with this kind of investment in a developing country, their growth potential will be increased, will be enhanced. And then the globalization after the crisis will be more inclusive. Thank you.
Thank you, Justin. I failed to introduce Justin. Justin was trained at Taiwan National University, also at Beijing University and at the University of Chicago, and is responsible for setting up the China Economic Research Center, among various achievements before being appointed as chief economist of the bank. He has recently defined his analytical position as a neoclassical structuralist position, but I'm not quite sure what that means. Our next two speakers, however, are both Keynesians, and albeit of slightly different persuasions in terms of being from different sides of the Atlantic. Our next speaker is Prabhat Patnaik, who's probably also, in my view, the leading Marxist economist working in the world today. He's written on a wide variety of subjects, including macroeconomic issues, and is professor at Jawaharlal Nehru University, besides being vice chairman of the Kerala State Planning Commission. Prabhat.
Thank you very much, Jomo, Joe, Justin, friends. It's a pleasure to be here and a privilege to be part of this very distinguished panel. I'd like to thank the Heyman Center and the Committee on Global Thought for giving me this opportunity. I'd like to discuss the whole question of crisis in a somewhat historical context. Typically, when we discuss the crisis, we concentrate on a limited range of events over a limited period of time, occurring in a limited region, typically the formation and the collapse of the housing boom in the United States during the current century. But in a sense, I think this crisis has to be located within a somewhat deeper context. And the reason is the following, that in any capitalist economy where you have asset markets, obviously these markets tend to be peopled by speculators who are driven not so much by prospects of earnings from the assets as by prospects of capital gains. As a result, you tend to have bubbles because people buy in order to sell the assets the day after tomorrow, which tends to build up bubbles, and the bubbles have the impact of actually generating a boom. Likewise, the collapse of the bubbles creates a crisis. But these booms and crises themselves are really superimposed on deeper phenomena. As a matter of fact, in a period when you have a secular upward trend for reasons which have to do with underlying stimuli to the growth process in the capitalist system, you find typically that the crises would be shallow, they would be brief. In fact, that is the way that the underlying upward movement is something that makes itself felt. So whether the crisis is going to be deep and shallow, or whether it's going, is going to be shallow and brief, or whether it's going to be deep and protracted, is something that really depends upon factors which themselves do not have anything to do with that particular crisis, but have to do with rather deeper long-term tendencies underlying the movement of the system at the time. Now, in periods in which these deeper underlying tendencies causing an upward movement are not there, in other words, in periods when there is no kind of sustained upturn for other stimuli, typically the crisis result in Great Depressions. The Great Depression of 1930s, in my view, was really one such period when one burst of upward movement had come to an end, the stimuli underlying that had finished, while no new stimuli had been found. So we had a protracted period of the Great Depression. And I'd like to argue that at the moment we are also in such a period, because of which I believe that no matter what the short-term movements of GDP and so on, even the current crisis is likely to be a fairly protracted one. If we look at the period of the Great Depression, let's just go back very briefly in an excursus into history, where we look at the period before the First World War. The entire period from the middle of the 19th century right until the First World War was a period of remarkable and pronounced boom in the world capitalist economy. This boom was sustained by an international arrangement which was underpinned by colonialism. And that arrangement basically consisted in the following. Britain, which was the leading capitalist country of that time, had an enormous current account deficit vis-a-vis Europe and the temperate regions of European settlement like the United States, because of which, as it were, they found markets in Britain. Britain sustained this current account deficit by running a current account surplus vis-a-vis the tropical colonies And that current account surplus vis-a-vis the tropical colonies was in fact made possible, not because the colonies were growing fast, on the contrary they were stagnant or retrogressing, but at the expense of displacing local production, what is called the process of deindustrialization, getting rid of older craftsmen, older production, especially in industries like textiles. The tropical colonies in turn had in fact current account surpluses vis-a-vis Europe and the temperate regions of European settlement. So you had Britain balancing her trade via the colonies, and this being made possible because the colonial market, according to the British historian S.B. Saul, was on tap. You could actually simply push your goods there at the expense of the artisans and so on. Not only was the balance of payments actually sustained this way, the British balance of payments, the leading capitalist country of that time, but what is more, Britain actually made substantial capital exports to the temperate regions of European settlement, not because it had a current account surplus vis-a-vis them, as I said, it was a massive deficit, but because the colonies had a current account surplus for which they did not get any credit, which was actually taken away by Britain through a process of what is called the drain, that the Indian nationalist Karl Marx himself kept talking about, which was a unilateral appropriation of surplus because of the colonial status of these countries. Therefore, the entire arrangement was something which was pinned down by the colonial system. Now, this could not go on forever because obviously there are there are limits to the extent to which the colonial market can be penetrated if there's stagnant markets. And secondly, you had a situation where the Asian tropical markets were increasingly lost to Britain because Japan came in. And thirdly, you had, of course, in the post-First World War period, a deep agrarian crisis preceding the Great Depression, which, as Kindleberger says, was because of the fact that the wartime excess demand for agricultural commodities was changed into a post-war regime of excess supplies of agricultural commodities, bringing about an agricultural price crash in 1926, which therefore meant that this whole colonial mechanism did not work as well as it had done earlier. Keynes, Alvin Hansen, and others have referred to the Great Depression as arising because of the closing of the frontier, that this whole business of exporting people and capital from Europe to the temperate regions of European settlement is something that really came to an end. But on the other hand, even if the frontier had not been closed, the means to get to the frontier via the colonies had got closed. In the post-Second World War period, therefore, on the basis of Keynes, you had an alternative stimulus which was suggested, which of course was state intervention in demand management. But of course, under pressure from financial interests who never like the state to play any active role other than in their own interests, you had a situation where typically state intervention in demand management has progressively been whittled down until, of course, there's some revival in the context of the current crisis. Because of which you find that from around the middle of the 1970s, the growth rate of the advanced capitalist countries has, in a secular sense, become lower than it was in the post-war period, so-called Golden Age. And what is more, even this growth rate has been sustained by periodic bubbles, with a dot-com bubble, a housing bubble or something. And the collapse of the bubble is now landed us in a situation where all the earlier stimuli are over and nothing new is immediately on the horizon. Of course, revival of the role of the state once more as a provider of demand, not just, as it were, interfering briefly, but once more as a sustained provider of demand, can revive a growth process again, can provide a new and sustained stimulus. But there are problems to this. The first and obvious problem, of course, is that this entails overcoming the opposition of financial interests. But even that is not enough. In other words, even if it is the case that the fiscal deficit could be sustained, could be continued, there are two additional problems which actually define the current situation. The first of these is that liberalization of trade has basically meant that, in a certain sense, wages in the advanced countries, including in the United States, are now no longer independent of the fact of the substantial labor reserves that exist in the world economy in the developing countries. Because if it is the case that such labor reserves exist, then of course labor from the advanced countries is competing against the low-wage labor from the developing countries, because of which, unlike in the old days when the following happened, namely productivity would rise, the rise in productivity in the metropolitan countries, in the advanced countries, would be accompanied by a rise in the wage rate. Now you have a situation where productivity increases in the metropolis are not necessarily accompanied by anything like corresponding increases in the wage rate, because the wage rate get tied to the fact of the wage rates prevailing in the developing countries, which in turn remain low because of the existence of substantial labor reserves. As a result, there's a tendency towards underconsumption. Those of you who will be familiar with this terminology, there's a tendency towards underconsumption of the Brannan-Sweezy kind in the world economy, to overcome which it is not just enough that fiscal deficits be there, but fiscal deficits would have to increase and would have to be sustained. Now, for an individual country like the United States to be doing so is obviously becomes to that extent far more difficult. This is something which would really require coordination. I think Jomo referred to the coordinated fiscal stimulus. It would require coordination across a number of capitalist countries. The second problem which arises is, as Jomo's diagram showed, that even in the midst of the current crisis, food prices remain extraordinarily high. They have come down briefly compared to the peak they had touched in 2008, but nonetheless, they remain extraordinarily high, and of course much higher than they were 2 or 3 or 4 years ago. Now, to the extent that is the case, any revival of the world economy, if it is not accompanied by a substantial increase in food grain production, is going to give rise to very serious inflation in these essential commodities. If you look at the per capita world food grain output, that has been declining in absolute terms over the last decade or 2.5 decades or so, from the middle of the 1980s. Many reasons for it, but one very important reason, of course, is the weakening of the position of peasant agriculture all over the world under the impact of neoliberal economic policies. In the dirigist period, the state everywhere, including in developing countries like India, supported, sustained, promoted, protected peasant agriculture, but increasingly this has been given up, leaving peasant agriculture to the mercies of the world market, fluctuations on the world market, and incursions by metropolitan capital, multinational corporations, agribusiness, and so on. As a result, the decimation of peasant agriculture, and I use the term advisedly because in India itself 200,000 peasants have committed suicide. The decimation of peasant agriculture has had the impact also of keeping food grain growth rate extraordinarily low. If that happens, then of course a revival of the world economy in terms of demand at this time, if food grain output does not pick up, is something which would give rise to inflation. To rely on this inflation causing an increase in food grain growth rate because the peasants benefit from high prices is unrealistic, because the impact of high food prices does not translate itself into higher incomes as far as the peasants are concerned. Supposing we had, in other words, the argument I'm putting forward, I can restate this way. Supposing we actually had a world state, not the US state or British state or the Indian or Chinese state. If you had a world state, then the world state could in fact have provided a stimulus to the world economy and could have done so by spending more, protecting, promoting peasant agriculture in the world as a whole, so that together with demand, food output could have been increased. Unfortunately, we don't have a world state. But such a world state, if we had, would of course have to be something other than an imperial state that is backed up or is interested in promoting the interests of finance capital, but it would have to be a democratic world state that genuinely looks after promoting and protecting peasant agriculture, promoting and protecting, if you like, the world's countryside. We don't have that, but on the other hand, obviously, the requirements of overcoming this crisis underscore the necessity not only of confronting finance capital and, as it were, reenacting a scene in which the state once more has a certain degree of responsibility in providing the stimulus to growth, but the state itself is one which has to be, as it were, coordinated with other states and would have to be informed by the outlook of promoting and protecting the conditions of peasant agriculture, as opposed to promoting underwriting the interests of agribusiness, multinational capital in the agricultural arena. What is required, in other words, is a global arrangement which actually is vastly different from the one which is currently existent, presided over by globalized finance capital. The transition from this to that is not easy, but the crisis underscores the necessity of this transition. Thank you.
Thank you very much, Prabhat. Our fourth and final speaker really needs no introduction to a Columbia audience. Nonetheless, I'm very tempted to pay homage to the late Paul Samuelson, who reputedly said that he had found his srafa when Joe Stiglitz published his collected scientific papers. Paul Samuelson, as you know, was the doyen of the neoclassical synthesis in this country, and passed away late last year. And Joe Stiglitz was one of his star students and published his collected papers. Srafa, for those of you who may not be familiar, published the papers of David Ricardo over a century, almost a century and a half after Ricardo had passed away. So Samuelson was rather pleased that the collected scientific papers was published in his own lifetime. Joe Stiglitz.
Okay, I think I'll stay here at the table so we can move on to the discussion afterwards. Let me just divide my remarks into first a brief discussion on how the developing countries have been hurt very badly, and then secondly a few remarks about where the global economy is going, including the impacts in developing countries, and then a third, very few remarks about how the nature of the crisis in capitalism. The developing countries, as Jomo very, very well pointed out, have been, in a sense, the innocent victims of the crisis. And this is very different from most of the other crises, of which there have been very many in the last 30 years, which began in the developing countries, and the worry was that they would spread and become global. The international community, at very great expense to the developing countries, managed the way through these crises so that none of them became a global crisis. The 97-98 crisis was called a global crisis, but did not seriously impact the developed countries. But the wrong inference was made from that experience. The inference was made that the economic system was self-correcting, and I'll come back to that, and that it actually reinforced the belief that the models that, again, Jomo referred to of liberalization were working, because life in the advanced industrial countries continued almost unaffected. But this crisis was one that began in the developed countries, in the United States, and then spread to the rest of the world. And they were hit through all the channels that were described, through trade, through finance, through remittances, through foreign aid. What made this particularly difficult, though, for developing countries was that the instruments, the resources that they had to deal with the crises were much more constrained than those in the developed countries. The developed countries responded to this crisis in a way that was totally different from the way that the IMF told the countries in East Asia to respond to the crises 12 years earlier. In that crisis, the IMF and the US Treasury told the developing countries, raise your interest rates, cut back your expenditures, and don't bail out your banks. And of course, in this crisis, we bailed out the banks, we lowered interest rates to essentially zero, and we ran very large deficits. But the developing countries in this crisis, for the most part, did not have the resources. There were a few that had large surpluses, large reserves, like China. And they were the best students of Keynesian economics, and they were able, they succeeded in keeping their economy going. But many of the other countries did not have the resources to do it. And there was a concern as a result that the downturn in the developing countries would be much more severe. And that was where in the figure in the slide that Jomo said, the IMF funds were increased by new SDR allocations of $250 billion. There were a whole set of variety of programs that gave the IMF more resources. But interestingly, relatively little of this money actually went to the developing countries. And the developing countries went through a slowdown, but seemed to be recovering, particularly the emerging markets. India and China have recovered with much less damage than I think a lot of us anticipated. And the question was, why was that? Before answering that, I want to make one comment about in those countries where there was a necessity of turning to the IMF, the IMF's position in most of those countries was markedly different from that was been pursued in previous crises, not only the 97-98 East Asia crisis, but also Latin America and Russia, crises all over the world. For the first time, the IMF actually changed its economic philosophy to be a much more, if you want to briefly, to be much more Keynesian. They recognized that they had been wrong in having, or some of the people, particularly the head of the IMF, recognized that it had been wrong to have pro-cyclical policies. It had counter-cyclical policies. For the first time, they became very explicit that the way they would measure when it was time to withdraw was when employment was restored to normal. And they openly talked about the need to maintain the stimulus so long as one could until employment got recovered. In the case of a few of the programs, like Iceland, the programs were not only were more expansionary, allowing the countries to run very large deficits, but they also allowed Iceland to impose capital controls, which had been almost an anathema to the IMF. So it was really a very marked change in most of the policies. The one exception at the other extreme was Latvia, which where the downturn in the GDP, I think, is one of the worst the world has ever seen, at least in recent years. Like downturn is 25%, I think. You probably know the numbers. And the IMF has been cheering it on, saying that they have to cut budgets more and restrict it. It's sort of interesting. that while they've changed their policies in most of the countries, there is this one exception. Well, it is a little bit interesting that the developing countries have not been devastated, for the most part, to the extent that was anticipated. I think one of the reasons for this is that especially China engaged in very strong policies of stimulus. And it grows slow from 13% to around 9%, but that was still very strong growth. And that maintained the relatively strong commodity prices, and the many other countries that were buying commodities were thereby helped. India has also done, in some ways, much better than was anticipated. Both of these countries are countries where there are large potentials for domestic economic growth, huge markets within their own country. And that is one of the questions going forward about China particularly right now. And I'll postpone coming to that until I come to the discussion of global imbalances at the end, because China is at the center of that discussion. But I think it is interesting that at this juncture, the developing countries, particularly in Asia, are doing reasonably well, and that in the economies of Europe and the United States are not doing so well. So there's been a kind of decoupling. And the question that is being asked now is can this be sustained? Is this just a temporary thing, or is it a more permanent feature? And I'll come back to make a few remarks about that. Let me talk about now some of the reasons that I feel relatively pessimistic about where the global economy is going. It focuses on mostly the developed countries, but a little bit on the developing countries. The first is something that the UN Commission emphasized, which is in a world of globalization, what matters is global aggregate demand, and global aggregate demand is in very bad shape. And you can put the issue in two different ways. One of them is what had sustained the global economy before the crisis was America's profligate consumption that was itself supported by this high level, by the housing boom, the housing bubble. And now that the bubble is broken, that won't be possible, and savings in the United States has increased from 0 to 5%. I'll come back to the attempt by governments to fill in the gap. But there's another way of seeing why global aggregate demand is likely to be weak going forward. One of them has to do with the fact that Prabhat emphasized, the fact of the growing inequality in the world. And a very standard Keynesian argument, I think, has a great deal of validity, that the marginal propensity to consume, the fraction of the income that lower income people consume, is much higher than that of upper income. And so when we distribute income from rich to the poor, total consumption demand goes down. And this increase in inequality is going on in most countries of the world. United States was one of the countries that has had very large increases in inequality. In the United States, we said to people whose income was going down or stagnating, don't let it bother you. Keep consuming as if your income was going up. And of course, the way they did that is through debt. And the reason they could do that was because of the housing prices. So their net worth looked like it was good, but it was phony. And that debt-sustained consumption is not going to be feasible going forward. So that's one problem, inequality. Not in all the discussion of going forward from the crisis, very little discussion about that inequality and how that can be rectified. And therefore, the problem that poses for global aggregate demand remains. The second reason that there is weakness in global aggregate demand that the Commission, the UN Commission emphasized was demand for reserves. That was related in part to the crisis of 97-98, where the countries learned what happened if you don't have enough reserves. One of the countries that crisis, the Prime Minister told me, he was in the class of 97. He learned what happened if you did not have enough reserves. The IMF came in and took away your economic sovereignty and then pushed policies that led to deep recessions or depressions. And so they and many other countries around the world started accumulating reserves. The problem with accumulating reserves is that is money that's not spent. And so there's a deficiency in global aggregate demand. And the magnitude of this in the decade, in the last decade, it has been enormous. It's in the trillions of dollars. This precautionary demand for savings, global reserves, is only part of the story. There are other parts having to do with export-led growth, having to do with the ability to pursue export-led growth through industrial policy being undermined by the WTO, and therefore putting more of the burden of export-led growth to exchange rate, which means when you use exchange rate policies, it gets reflected in foreign exchange reserve buildup. The point I'm making here is that there had been export-led growth models for decades without reserve surpluses being built up. And the question is, why did that change? One possible explanation is the WTO. So that's part of it. But the part I'm focusing on right now are the precautionary demand. Why is that important? Because countries have learned that those countries that had large reserves did better in this crisis than those that didn't, because it enabled them to have Keynesian policies, to have expansionary policies. So the worry is that there will be an increase in demand for reserves, and the insufficiency of aggregate demand related to reserves will get worse. The IMF has realized this, and in their meeting in Istanbul last October, they echoed the notion that a key part of dealing with the problem of global reserves is to reduce the demand for the buildup of reserves. Key part of the problem dealing with global imbalances is to reduce the demand for reserves by providing alternative methods of insurance than self-insurance. Reserves are a form of self-insurance. They said, well, people won't have to build up the reserves if they have other ways of providing insurance. And the IMF offered themselves as the way of doing that. They would provide a security blanket for all the countries of the world. Unfortunately, most of the other countries of the world said, we don't trust you. They said, in effect, they said, we may like Dominique Strauss-Kahn, but the fact that he could change the IMF so quickly means that the next guy could switch it back. And if we get rid of our reserves in 4 years' time, how do we know that the IMF will be the same nice consumer-friendly IMF and not go back to the IMF that everybody had loved so much before in the 90s? So the general sense is that the buildup of reserves is not going to diminish, may actually accelerate one of the outcomes of the crisis. Now, that's one of the reasons for the pessimism. The second is the reason it's already been mentioned by several people, that what had filled in the gap for a while was government stimulus packages. But those are coming to an end, and the willingness and ability of governments to renew it is diminished because of the huge increase in deficits and national debts. I don't think this is a good argument, but the financial sector, which was very short-sighted in causing the crisis, has now become short-sighted in saying that we should not have a stimulus. And they have been drumming up the view that what I call deficit fetishism. Very strong view that the governments should not have deficits. The point was made, I think by several of the speakers, that in fact, if governments spend money for investments, in fact, all it requires is investments with returns of about 5 or 6%, and the long-term national debt will be lower than it would be if the government did not spend the money. So the deficit fetishism is really bad economics, but the banks, the financial sector, bad economics is what got us in the crisis, and they are now dominating the political process. The likelihood that the United States will have a second stimulus of a significant amount is very low. And in Europe, it's even worse. They're beginning contractionary measures in Spain, in Ireland, in Greece, Portugal. And so they are going back to Hooverite policies, and prospects, I think, are very bad. The third problem is again related to the financial sector. They are now beginning to reemphasize their standard line that the underlying problem is wage rigidity. That if only workers took a further wage cut, then everything will be fine. The problem of unemployment is too high wages. And you saw a front page article in the Wall Street Journal describing this today as fact, that what workers need to do is to take a further wage cut, which would lower aggregate demand. That's not the way they put it, but that would, they believe, would solve the problem. So if that happens, of course, aggregate demand will be further lowered and the problems worsened. So the automatic stabilizers worked in this recession. In fact, about 7/8 of all of the stimulus came from automatic stabilizers. And what the financial market now wants to do is to short circuit those automatic stabilizers. I don't know whether the extent to which that will work, but it will. The downward pressure on wages is exerting a depressing effect on the economy. The fourth problem, a reason of pessimism, is everybody began this crisis saying we have to be wary of protectionism. And we all know what happened after the leaders of the G20 said that we would not agreed not to engage in protectionism. Within 3 months, 17 of the 20 countries had engaged in protectionism, America being among them with the Buy America provision in the stimulus package. But I still think that actually the protectionism was muted. It was a lot of, it was outrageous, but it was muted. And that was partly because of the WTO. But now that monetary measures have come to an end, fiscal measures have come to an end, that leaves but one instrument left, and that's protectionism. And the United States is now getting prepared, I think, for a trade war with China. The rhetoric, I just came back from China, is very, very intense about exchange rate manipulation. The Treasury has to make a decision fairly shortly about whether China is an exchange rate manipulator, and the betting is 50-50 that it will do that. And that clearly is clouding the sky. Finally, let me make a couple remarks about global imbalances that have been referred to a number of times as part of the crisis today and going forward. Let me make clear, while a lot of people talk about the global imbalances, they did not cause this crisis. I don't think they contributed even to the crisis in a significant way. The crisis was caused by America's financial markets not doing their job, this bubble. But I do think global imbalances are important. I think there is a real worry about disorderly unwinding of the global imbalances, and I do think that there's a very significant risk they will cause the next crisis within the next few years. So I think it is important for something to be done, and it's related to the problem of protectionism, because the U.S. sees the deficit, trade deficit, and that is part of the forces generating demand. I think demand for protectionism. I think G20 discussions of coordination are going to go nowhere. I mean, I've heard these discussions of coordination. As far as I can see, there has been no effective coordination almost ever. And it's not going to, you know, they will talk, but the best that can be said about the crisis, response to the crisis, it was a little bit like side-by-side play. Each of the countries went to the meeting saying, this is what we're going to do, and they left the meeting doing what they said they were going to do. And as far as I can tell, I think there was no change in policy by any country as a result of the meeting. Maybe I'm wrong, but certainly not a very large response. But the global, where the global imbalance discussion is taking place today is that there is a lot of pressure. What the agreement in Pittsburgh was that U.S. would save more and China would save less. Now, the U.S. has actually reduced its savings, not increased its savings. That is to say, what happened is household savings went up, but government savings went down and more than offset the increase. So in that sense, that if we were at full employment, the global imbalances would be worse. But on the China side, savings hasn't changed, but the remedy, I think, is wrong. I think the problem with the world global economy is not that there's too little savings, but that too much savings, but the savings weren't directed at the right place. And so the real challenge, this really is what Justin was saying, is really one of redeploying the savings. Internationally, it needs to be dealt with the problems of poverty in the third world and global warming globally. And within China, there's a need to, rather than using the savings for excess capacity in the way, China has very big challenges of urbanization, of health, investments in education and technology. So in general, while I think there should be some increasing savings in China, the main thing should be a redeployment of the savings into more constructive investments rather than the excess capacity. Finally, let me say, I think while we've talked about this as an economic crisis, it is a crisis in capitalism. The basic model of capitalism was that it's a model which was self-adjusting, markets self-adjust. We know that that was not true. That is to say, we've had crises over and over again in the history of capitalism. The only period in which there was not a crisis was the 30-year period after the Great Depression, when we put in place good regulations. Regulations can work. So the markets are not self-adjusting, but we haven't really fully taken on board what that applies for the working of the market economy. So that so far in the United States, there has not been any, or in Europe, a significant change in the model of the economy. At least in Europe, there is a lot of discussion of a new capitalist model. In the United States, the strongest discussion is maybe a little change in the plumbing, no change in a view of the economic system. But from the analytic point of view, the theoretical point of view, there remain some difficult questions, and maybe just throw this out partly to start the discussion. The standard general equilibrium model talks about eventually demand equals supply, markets work, not just fast enough. And the kind of historical analysis that Prabhat made was really quite apart from that kind of market processes. And so one of the questions is, you know, that kind of historical analysis provides an interesting description of what has happened, but I think that has to be brought together with the discussion of what why is it that the market processes, which are supposed to eliminate excess demand and supply, supposed to bring markets into equilibrium, which part of that isn't working, and why aren't they working? And from the policy perspective, what do we have to do to get the economy not only back on track, but prevent another recurrence? The final general point is that I share the pessimism, and that I think Jomo expressed in the beginning, that we're likely in for a very long period of Japanese malaise, which will be of the form that we aren't in a deep depression of the kind of the 30s, but neither will we be in a robust economic growth.
Thank you very much, Joe. We have some time for discussion. I would like to remind you that this event is being recorded, so please use the microphones when you make comments or raise questions. There are microphones in both aisles.
Hi, I have a question for Professor Patnaik, but I guess it could...
Could you identify yourself, please?
My name is Lakshmi Gopal. I'm a student at the School of General Studies. I wanted to know, we've been talking a lot about the current economic crisis, and we've been talking about the difference in the impact between how the economies of the West have suffered and how the economies of the East have not suffered as much. I think back, I've spent 15 years in this country, I spent 5 years in India, and I think back to the time when I think the World Bank was trying to convince all developing countries to use DDT and pesticides in order to expand and improve on their crop intake. And now, 10 years later, as an adult, I see suddenly we're all green. And we're trying to get rid of pesticides, we're trying to go organic, and we've seen the errors of the earlier policies. And I see this in so many different arenas where there's suddenly these big gurus who speak about all sorts of different magical solutions. But it seems to me that, especially given the recent economic solution, isn't it time that we channel our own sort of, channel our own internal experience and come up with different solutions? I think Professor Stiglitz was talking about how we need to ask questions about the system of capitalism itself and try to figure out where the problem is and find the solutions. But I mean, shouldn't we really be examining history and trying to see what we can do in terms of, at least for the East, maybe not for the West, new solutions? Because capitalism, like Professor Stiglitz says, is constantly in crisis.
Thank you. Yes, please.
This is for
Could you identify yourself?
My name is Jonathan Hogstad. I go to Columbia School of International and Public Affairs. I was surprised to see that you called attention to the excess capacity, but then the solution was investment in productivity. And that seems to be getting away from the idea that we have a consumption problem that stems from a distribution problem. And this seems to underlie a lot of the logic that goes behind World Bank policies. And I'm thinking about agriculture policies mainly, and one example would be the privatization of irrigation services in the Philippines, which are for small rice farmers. That the idea is you increase production by injecting some capital into irrigation, but you lose. That doesn't take into account the power relations between the owners of the means of production of being the irrigation service and the small farmer, which is going to drastically affect the distribution and the amount of the surplus product that the farmer is going to get to keep eventually. How would you address this logic in the context of this crisis and in the context of the ongoing food crisis?
Next, please.
My name is Elton, and I go to SIPA. My question is, it seems that in the last 100 years, the U.S. has been the locomotive of the world economy. Do you think that will change in the future, as it seems that developing markets are leading the way out of the recession now? Thank you.
Thank you. Stephanie, please.
Yeah, I'm Stephanie Griffiths-Jones. I work at IPD. I wanted to ask two questions, if I may. One, from Joe, he very interestingly pointed out how the financial markets refuse to fund government debt and force countries to follow deflationary policies, like in Greece. I wonder, I think there's been very little thought about what can be done about that, and how these financial markets that have been rescued by governments now refuse to fund governments. And I was wondering if you had any thoughts on how that perverse link could be broken. And I wanted to ask particularly Justin Lim, but also other speakers. The World Bank and the Regional Development Bank seem to have a lot of mechanisms, and they've created a lot of kind of crisis acceleration facilities. But when one looks at the disbursements that have actually happened, not so much the commitments, in the wake of the crisis, they haven't increased very much. And I was wondering what thoughts have been given to how this could be changed.
Hi, my name is Alex. I'm a first year at SEPA as well. You mentioned that the 30 years after the Depression had some of the most sustained growth without crises. And is it naive to think that just sort of increasing regulation and restoring Glass-Steagall would be a way to, I guess, you know, circumvent the next potential for a crisis? And what do you think the prospects are of that actually happening?
Okay, right. Thank you very much for that round of questions. Let me now invite. I will probably have to leave in a few minutes. So if I may just make a short intervention and then ask Joe to preside over the balance of the proceedings. I would take a point which has been made by several speakers, and that's the whole question of coordination and achieving a balanced stimulus. Justin has emphasized the point of excess capacity. One of the areas in which there is no excess capacity is in renewable energy. One of the problems of poverty is that many people in the world are poor because they actually have limited access to to energy, and energy costs a great deal to them. One of the major areas in which you could develop tremendous capacity where there's no excess capacity is in renewable energy generation. The other area, of course, is with food production. But one of the major problems standing in the way of food production, particularly in developing countries, has been trade liberalization. Because trade liberalization has proceeded together with huge production subsidies, particularly in the rich countries. If we can find a way of addressing those two issues simultaneously, in other words, in the form of some kind of global Green New Deal, if you will, we have a good chance of addressing two of the major problems of our times, namely the challenge of climate change as well as the food problem, while contributing to economic recovery, a balanced economic recovery. That, I would suggest, remains the major challenge. It's not going to be achievable without the kind of international solidarity and cooperation, which I think all of us recognize to be part of the problem. But we really need that kind of effort. So I want to thank the Hyman Center for having me here today, and to thank the panelists for their interventions, which have been all very interesting and stimulating, and invite Joe Stiglitz to take over and preside over the session.
Okay, thank you very much, Joe, for coming. And let me just ask Justin to give a response to several of the questions that were addressed towards you, or to any of the other questions or comments on what any of the other speakers have said.
Well, I just like to, because I think I see most of the presentation and the argument you have, and so I'd just like to respond to the question. The first one is by John, regarding the excess capacity and my argument for investment in order to get out of this excess capacity situation. I think that it depends on what kind of investment we are referring to. If we use the investment in the manufacturing sectors, then certainly it may build up the capacity. But as I mentioned now, the excess capacity is mainly in the capital goods sectors in the high-income country. And the investment I'm arguing are basically infrastructure or energy efficiency type of investment. Those kind of investment, were not directed add up to the capacity in the capital goods sectors, but they will use the capital goods for their investment. And also, after they completed, in general, those kind of infrastructure are not tradable, right? If you have a highway system, it's not tradable. It may indirectly contribute to export capacity because efficiency improve, but that is indirect contribution. But at the same time, if your infrastructure and so on improve, transaction cost reduced, efficiency improve, your export increase, but your import will also increase. So it's likely to be balanced. So that issue has been taken into account in my proposal. And regarding,
can I just add onto that? I mean, for instance, what I commented about the need for investments for urbanization. There's about 1% of the population that moves from the rural to the urban sector. The urbanization in China is very high density, tall buildings, use a lot of steel. So government investment to provide housing for ordinary citizens actually is a very heavy demander of steel. So that's an example of investment that will actually use up the capacity. Go ahead.
Very true. And regarding your question, Philippines irrigation, privatization of the irrigation and its likely impact and so on, I'm not aware of that project. And if you have some information, I'll be happy to get that and to understand more. And so maybe I'll be able to respond privately in that way. Regarding the crisis facilities and so on, from what I see, that so far I seem to be quite responsive. And we tripled the lending last year compared to pre-crisis level, and that seems to work to some extent. And certainly there should be some room for further improvement. But at least in terms of volume, it has been tripled.
I'd just like to emphasize that, that when we think of the crisis, we actually are thinking in terms of the falling output, the unemployment, and so on. But even before the crisis actually happened in this form, there was growing hunger in the world, there was growing malnutrition in the world. In other words, this particular crisis is superimposed on something deeper. And I think this is linked to the whole question of capitalism. The issue is not just coming out of this particular crisis. The issue is to come out of this crisis in a way that does not accentuate hunger, that does not accentuate malnutrition, that does not, in fact, imply a further squeeze as far as the consumption of the poorer people in the world is concerned. Therefore, the way of engineering, if you like, a stimulus not only has to be coordinated across countries, but also has to take the form in which that stimulus simultaneously also gives rise to an expansion in food production, to a revival of peasant agriculture, and so on. I emphasize peasant agriculture because you can have an increase in food production even if you have corporate farming, but then there are vast numbers of people who won't have the purchasing power to buy the food which would be so produced. So it's extremely important, given the fact that the displaced peasantry is not going to be absorbed in the foreseeable future into any kind of an expanding capitalist workforce. It's essential that actually the way of coming out of this crisis must be one one that actually sustains and supports peasant agriculture and also raises food production so that the basic problem of hunger is overcome even as we come out of the crisis. I think that's why the whole political issue is very important, because I think one of the main features of contemporary capitalism is that it is engaged in dispossessing small property, dispossessing small producers, dispossessing petty producers, dispossessing peasants and so on. As you know, both in India and China, there have been very substantial numbers of clashes where the peasantry has resisted actually the dispossession from land for the purposes of industrialization and so on. So I think it's quite important that the issue of capitalism must be discussed in the context of an entirely alternative growth trajectory that would have to be a non-capitalist trajectory that actually respects the position of the peasantry, that actually protects them.
Let me just make a couple of comments. The first is a very general one about, in a way, the crisis showing many of the remarks here, the deficiency in the way the market economy works. I emphasized more before the point that it's clearly not self-correcting, not self-adjusting. But there's another point that comes out very clearly, which is that we've all identified a problem of excess supply, but we've also all identified areas of huge demands, or needs, let me put it like that, huge needs: poverty, global warming, food. And somehow the supply and demand is not equilibrated in a way that's consistent with what we think would reflect a well-functioning economy and society. And the analytics of why that is seems to me a really key issue that needs to be thought about a lot more. In a way, I want to spend just to mention something about the financial system and regulation. Several of the questions related to that. The first thing is to realize that modern capitalism, and exemplified by what goes on in the financial sector, is rife with problems of agency. That is to say, the people making the decisions don't bear all the consequences: separation of ownership and control. People doing investing are doing investing on behalf of others, and pervasive externalities. Problems in the capital market, in the financial markets, led to problems in the rest of the world and the rest of our society. And whenever that occurs, good decisions aren't made. And that's why you need regulation, to try to bring those, A, to bring those better into accord, but B, recognizing that they are not in accord and will never be brought perfectly into accord, prevent, mitigate some of the adverse consequences that will result. And that's why I think, actually, the general point that is often raised, regulation will stifle innovation. I think that's wrong. Good regulation will actually encourage good innovation. The problem is that the innovation that occurred was induced not to solve society's problems, but to generate fees, and actually did not lead to any improvement in the functioning of our economy. So that's why it's absolutely essential to have stronger regulation. Now, the question was, should there be a reinstatement of the Glass-Steagall? Will that be enough? Well, you obviously can't reinstate the Glass-Steagall in the way that it was 75 years ago, but that kind of separation is an example of the kind of regulation that we need. Volcker has talked about this, restrictions on proprietary trading. There are a whole set of restrictions. I think the Volcker rule did not go far enough. It was much, but it identified a couple of the problems, and was a move in the right direction. But there are still the problems of too big to fail institutions, credit default swaps. Good regulation would, I think, have the effect of directing the financial sector and allocating capital more efficiently, better. So more of it would be wind up in providing credit, say, to small and medium-sized enterprises rather than speculating against Greece. Whether it would ever actually, the issue about financing particular countries, I think there's no easy way of answering that question. But clearly, if their attention was directed more at lending as opposed to gambling, I think things would work better. One of the questions was had to do with the locomotive for growth. Will the developing countries continue to be? Will the U.S. be a locomotive of growth? I think the answer for the immediate future is that we will have to be looking for the emerging markets as the engine for global economic growth. I mean, really, that I think the problems that I described in the U.S. and Europe are sufficiently deep-seated that one cannot expect that the U.S. or Europe to have robust growth. I hope I'm wrong, for the next 2-3 years, or perhaps longer. Last year, I believe, Justin may tell me, 50% of the global growth was in China. So of all the growth that occurred in the world, 50% was in China. I think those are the numbers I saw recently. The final point, I guess I want to, I thought the remark about the fact that so often the advice of the gurus has been wrong should induce a sense of modesty. Example was mentioned about agriculture, but of course the example that Jomo mentioned in the beginning of his talk, the IMF and the World Bank encouraged capital market liberalization, financial market deregulation. The good thing was that the World Bank moved away from that position in the beginning of 1997. The IMF has taken a lot longer to move away from that position. But I think the fact that so many of the ideas that were taken as conventional wisdom have now been shown to be wrong is one of the reasons why there should be, whether there is or not, should be not only a crisis in capitalism, but there should also be a crisis in the economics profession. Well, thank you very much, and I want to thank the speakers very much.